Hello, my name is Oliver and welcome to my very personal finance channel. Some months back, around May, Aviva had a stock split and dropped to around £3.90 per share. I made a video on it at the time stating that I'd be buying them and showed some technical analysis charts to justify my position. A few of the comments out there pointed out that I should be using fundamentals to value a company rather than technicals, so I got a few books and started reading up on fundamentals. Having recently just finished Benjamin Graham's The Intelligent Investor, which actually proved to be the most useful book out of all the ones I read, and I do need to read it a few more times to fully understand a few of the points he was making, and especially do some more research on reading balance sheets and things like that. I think I've managed to get at least some of the basics down, so I thought I would apply them to Aviva and just see if we should continue buying them. So first things first up front, obviously, not a financial advisor, not an investor, not a professional. I'm learning as much as I can when I go along, but even when I put videos up and people comment, they tell me things that I then go and research and do a deeper dive in for my own benefit. So I'm not good. I'm not good at investing, not yet anyway. But yeah, we're learning. It's a slow and steady process. So I'm fallible. I'm just a random guy on the internet. But this is going to be my application of the information that's provided from Benjamin Graham's book. One of the things I will say as well is I'm a sucker for being lazy. So I've gone through and import the data from Yahoo Finance. This basically just means that I'll be able to do a refresh all, and that will update the information automatically, and then these things that I've got that run some automatic calculations will just update, and then it's a bit of effort now and it should save me a lot of effort later every time I come to reevaluate the companies, which I intend to do every sort of 6 months from now, and I'll do this to each of the stocks that I hold in my portfolio as well. So yeah, it'll just save me a bit of time. Anyway, with that being said, the first thing that Benjamin Graham goes on to talk about is the earnings per share. So he's basically, the earnings per share are the current earnings per share. So the moment for Aviva it's 10 cents, or 10 pennies, sorry, it's 10 pence, divided by the current stock price, which is £4.40. Now, £4.44. So the current PE is currently 44.46. Now, for Aviva, I would say that that's wildly high. I'd aim for a PE ratio of around 15 for something like Aviva. That's not a static number. It's just what I think it should be at based on the company's size, their physical assets, and based on the amount of staff that they've got. If, for instance, they were into heavy industry, they had a lot of overhead, oil rigs, big tankers, a lot of things to maintain, like earth moving equipment or cranes, and then I'd go for a more of a lower PE, so around 12. And if they were conversely a software company that basically just needs, well, in today's day and age, basically just needs a laptop to function, then I'd probably go for a PE of around 20. One of the things Benjamin Graham is careful to stress is that you take the price to earnings over the past 5 years. So I've done 6-month increments over the past 5 years. I've taken all of the earnings per share, added them up, divided them by 10 to get 34.357 pennies. Now, if we take the existing stock price of £4.44, divide that by 34.357, we get 12.94, which is just below the ratio of 15, which is our max. The reason why you do this is basically because companies have good and bad years, and you don't want to miss out on a good company because of one bad year, and you don't want to miss out or buy a bad company based on one good year. So it's just a way of protecting yourself. The next one is the debt to asset ratio. I've yet to sort of fathom how to put this into a proper calculation, but their current assets are 13.74 billion and their current debt is 6.91 billion, which if we put that into a calculator, if we were to do 6.91 divided by 13.74, we get 0.5. So if we multiply that by 100 for the percentage, we get 50.29%. So I'd be happy rounding that down to 50. So that's just in our window of 50% debt to assets ratio. So again, happy with that. And the reason why it's a 50% debt to assets ratio is because you want to know the company's got enough liquid cash or enough assets to be able to weather any sort of financial storms that might arrive, and I'd be comfortable saying that Aviva definitely can. The final thing that Benjamin Graham stresses is the price to book ratio, which is here in column J. As you can see, it's 0.89. Typically you want it around 1, which it definitely is. I wouldn't go any higher than 1.2 for a price to book. But you get that by basically dividing the company's total assets, then subtracting their debt, and then you divide that number by the amount of shares that are in existence, and then that gives you a book value per share, which here is £4.98. So if we were to take £4.44 and divide it by £4.98, then we would get a value of 89 or 89%, which to me again means it's a good buy. One of the final things that I would personally check is their dividend. So for me, I look for at least a 4% yield. Now Aviva's current dividend yield is 7%, which for other companies I would suspect as being unsustainable. However, because I think Aviva is undervalued, as that value increases, their dividend yield will decrease, which I think will bring it back down to a more sustainable percentage, or sustainable looking percentage, shall we say. And they currently pay about 21 pence a year, and this year they're slated to pay about 30 pence. So it's not a bad buy. Taking this information, I don't really want to do forecasts, but for me, I would say anything under £4.60 is probably a good buy. Anything between £4.60 and £4.80 is a fair buy, and anything over £4.80 I would be a little bit nervous about purchasing because of the probable loss, or the chances of probable loss. If we were to take their current or the average earnings per share and then times that by 15, we get £5.15. So I would say that between £5 and £5.10 is a reasonable price to be paying for Aviva, or a reasonable share price that we should be seeing in the near future. I don't really want to do any forecasting on this channel because, in all honesty, I think it's a nonsense, and anyone who forecasts a share price is guessing. It's the politest way I can put it. Is they're just guessing. I mean, if you look 12 months ago, you wouldn't have thought that Ukraine had been invaded by Russia. If you'd looked 6 months ago, you wouldn't have thought that Liz Truss would have beat out Rishi Sunak. And if you were to look last week, you wouldn't have thought the Queen would be dead. So there's a lot to be said. I mean, you rely on a lot of fair weather objects to forecast a share price. So I don't want to be doing that. All I want to do is look at the existing data and determine if what I'm paying is good to a fair value. And in this case, I think it is. I'll do this for each one of the shares that I possess. And yeah, hopefully we get some interesting results. I won't be putting that on video unless there's any sort of interest to it. But that's basically how I'm going to go along valuing shares going forward. And that's everything from me. Bye.